If you're a beginner who's intimidated by options and doesn't know where to start, this ultra simple yet powerful strategy just might be perfect for you. I'm Mike Bellafiore, and we're one of the top proprietary trading firms in the US with numerous 7 and even 8-figure per year traders. We hope you agree you've found the right place to help grow your trading account.
Hi, I'm Seth Freudberg. I'm the head trader of SMB Capital's options trading desk here in Manhattan. And there are 2 myths out there about options that drive me crazy. The first one is that options trading is dangerous, which is an absolutely goofy idea for so many reasons. In fact, I could do a whole video on just that topic alone, because the reality is that in many ways, options trading is safer than buying stocks or shorting stocks. But we can save that topic for another video if you guys are interested in know more about why I say that. But secondly, and what is the topic of today's video, is that options trading is not complicated. It's actually really easy and gives you so much more flexibility than buying and selling stocks that it's not even close. And so in today's video, we're going to be describing the absolutely easiest options trade you can make. And once you understand it, which should take you about 30 seconds, seriously, I think you may well fall in love with options like I did 20 years ago when I first started trading them, and that love affair has gone on ever since. Okay, so let's jump in. If you're a beginner, you may not know what a put option on a stock is, so I'm going to share that with you right now. See, if you own 100 shares or more of a stock, and you're worried that the stock is going to go down, you could, of course, sell that stock. But if you'd rather hold on to the stock for the long term for whatever reason, then one alternative available to you is to buy a put option on that stock. The way a put option works is that you pay what's called a premium, a charge in other words, and what this payment gets you is the right to sell your shares at what's called the strike price of the put option, no matter how low the stock price goes. But if the stock closes above the strike price of the put option on the day the option expires, then the one who sold you that put, the put seller, basically wins the bet. The put option expires worthless, and the put seller walks away with all of that put premium, which, if you think about it, is his payment for taking the risk that the stock would drop way below the put strike price and he'd be stuck buying the shares way above market. So for example, if you own 100 shares of Microsoft and it's trading at, say, 517, but you feel that it might drop over the next few months because maybe you think it's been overbought lately, then in that case, you could buy a Microsoft 515 strike price put option expiring in 3 months. And so let's say that Microsoft goes down to 400 in those 3 months. In other words, you were right. Stock went down. Then you just go ahead and exercise your put option, sell your shares for 515, saving yourself $115 per share compared to the market price of 400. But don't forget, if the stock had closed above 515, then you would have lost all that put premium because the put seller's off the hook. The option's expired, so he just pockets the put premium that you paid him. And here's the part that most people don't realize. See, most of you have probably heard of buying put options, but did you realize that your broker will allow you to sell put options as well? In other words, did you realize that if you want to, you can sell put options, collect the premium from the put buyer, and if the stock doesn't close below the put strike price on the day the option expires, you pocket the premium. Well, what most traders don't realize is that as long as you have enough capital in your account to buy 100 shares of the stock at the put strike price, your broker will let you do just that. Be the guy collecting that cash for taking that risk. And so let's go through how this works and why it can be such a powerful yet simple practice that could revolutionize the way you trade and invest. So let me give you an example of just how powerful this can be. So we're going to head back to June 18th of 2024, and let's take a look at this price chart of Microsoft. And on that day, as you can see, it had closed at 449.78, having broken out from its 430 resistance area, which has been holding since late March. And so suppose that on that day you were thinking that you are willing to own Microsoft at 430, but no higher. And therefore, it would require a retracement for you to actually be willing to buy the shares. And so let's say that on that day you pulled up an options chain that expired about a month later on July 19th. And you went ahead and sold a 430 Microsoft put expiring on July 19th for a price of $315, as you can see. Well, when you do this, selling a put on a stock you are entering into what options traders refer to as a cash secured put trade. And it's basically the easiest trade that a beginner option trader can make. So before we go through the logic of this trade, let's first focus on the cash flow of what just happened. Remember, when we sell an option, we're the ones receiving the cash, and so we get a price of $3.15 in this case. But remember, every put option represents the right of the put owner in relation to 100 shares of the stock. So you multiply that price by 100. And so in this case, we received $315 for entering this trade. And also keep in mind that if you make a trade like this, you need to have the cash to buy the shares if they get assigned to you, which is what will happen if the stock closes below the put strike price on the day it expires. So in other words, if it closes below 430 on July 19th, you'll be assigned the shares and will have to pay 430 times 100 or $43,000 for those shares. But remember, your initial thesis was that you'd be long Microsoft at 430, so that'd be a good thing, right? Now let's move to the close on July 19th, the day that this option expired. And as you can see, the stock at first bounced after we entered the trade, but then began to sell off such that by July 19th, the stock had closed down at 437.11, lower than the day we sold the put, but not below 430. And so this first trade is a flat out cash winner for you, because with the stock closing at 711 higher than the put's 430 strike price, then that put just dies and closes with no value, because obviously no one's going to exercise their right to sell their shares at 430 when they're trading higher in the open market. So the put just expires worthless, and the trade profit is the original $315 that you collected. And so you clearly won that trade. You pocketed $315 for after a month for, if you think about it, simply promising to buy something at 430 when it closed way above that, and so that promise has no value on expiration date. And so let's just do it again. Sell another 430 put expiring about a month out, because remember, we're willing to own the shares at 430, and as we just saw, if the shares never drop to 430, we get to keep the cash. So either way, if you think about it, we're pretty happy. And now this time, the closest expiration to a month out is the August 16th, 2024 options chain. So we just go ahead and sell the put again at that 430 strike price, but you'll notice that the put is priced at $10.47 this time, more than triple what it was selling for last time. But remember, Microsoft's price is now $7.11 above the strike price, which is lower than it was the first time we did this. And so naturally, the market is going to expect a larger premium for taking that risk. And that's why the premium is so much larger this time. And so this, of course, means that we'll be collecting $1,047 as our cash flow for selling the 430 put expiring in August. So we're collecting a lot more. Okay, so now let's move to the day that this August option expires. And as you can see, by August 16th, Microsoft had sold off even further. And by the time August 16th had rolled around, Microsoft ended up closing at 418.47. Which this time is below the put strike price of 430, and so we're now going to be assigned those shares at 430, the price we were hoping to enter the trade in the first place. Okay, so let's take stock of where we are at this point in the trade to make it clear what's happened, and that is pretty much according to our plan. We collected $315 from selling the July put, and we added to that the $1,047 from selling the August put, for total positive cash flow of $1,362. Plus, we own 100 shares of Microsoft at $430 per share, having been patient. And we collected our $1,362 while being patient, having sold those puts. And then finally, we get our price, $430 per share, exactly as we had intended. Now, let's move forward to the present. And as you can see on October 20th, Microsoft is trading at $516.81 on that date, having rallied more than 86 points off of our initial $430 entry price. And so to calculate the total trade profit to date, you take the cash flow from selling the puts before we were assigned the shares, add the value of those shares today, and subtract out the cost of those shares originally when we were signed, which, as you can see today, would provide us with a profit of $10,043. So what I'd like you to take away from today's video is that professional and retail options traders like yourself have this incredibly unique opportunity to enter into a trade where you get to just keep collecting cash for selling cash secured puts month after month until a stock drops to the price that you named at the beginning of the process. Then you get to take possession of those shares at that entry price that you wanted. And if your bullish long-term view of the stock is correct, you'll make more money on the stock because you entered at your disciplined bargain price instead of just jumping into any price that the market happens to be valuing things at that moment, whether they're overbought or not. Another way of thinking of cash secure puts is, if you think about it, it's that the market is paying you to bid on a stock at a price below where it's trading today. If your bid is accepted, then you're happy because you got a stock at a bargain price that you assigned and you wanted to acquire that stock at that price. And the market pays you for waiting for that price and then ultimately grants you the stock at your price. In other words, you get the stock at the price you want and you get paid for bidding on that stock at that price, no matter how many times you submit that bid. In other words, no matter how many times in a row you sell a cash secured put. It's a pretty sweet strategy if you think about it. And once you start to understand how flexible and creative you can get with options, the more you're going to understand why professional traders love trading options.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.